Hello, everyone. Today we are discussing Fiserv. This is a stock that historically was seen as a compounder, but this year it has just simply fallen off a cliff. It peaked in February of this year, and since then it's down 70%. And a big part of that drop came after the last quarterly results, the Q3 quarter. And we'll be talking about why in a second. But a lot of people after this drop have been trying to figure out if now is a good time to buy Fiserv or not. If you're not super familiar with this company, it has been going through a lot of changes lately. The CEO for the previous 3-4 years that was really good to the company left at the start of the year to join the Trump administration, and he was replaced with another guy. And so, in the leadership, there's been a lot of changes this year. There's a few things that caused the big drop that we saw on the stock chart. The first one is that the revenue growth is slowing. This is a company that was growing at 8 9% per year in the previous years. And this quarter, that growth came down to just about 1%, which was way under expectations. But if it was just for that, the market would not have reacted the way it did. What was a lot more alarming were the comments made by the CEO to explain those results. This is an article by Payment Dive, and basically, the new CEO, Mike Lyons, announced a critical and necessary reset for the payments giant. We are shifting our strategic focus and our culture to prioritize sustainable, client focused opportunities, adding that this pivot will negatively impact near term results. So later on in the article, they describe how they had a full independent team looking at the business as a whole. And what they found out was that the previous management was pumping the near term results in order for the chart to look good, and that the level of growth and the level of margins that Fiserv had been posting up to now were just unsustainable. And so it's almost a necessary thing for the margins to come down due to more investments, to make the products better, and to slow down the revenue growth at the same time. So, obviously, that's not the type of news you want to hear as a shareholder. And that was the main cause for the huge drop in the share price. Now, the interesting thing is that Fiserv, after the drop, is trading at a very attractive multiple, a very attractive valuation, just under 9 in terms of free cash flow multiple. And if we take a quick glance at the financials, we can see that the revenues are steadily growing. Like I said, the previous few years had seen revenue growth of 9%, 7%, and this is expected now to drop maybe to 1% or 2. As we'll see later in the video, it's not super clear what to expect, and that's maybe one of the reasons why the stock price is down so much due to all the uncertainty. People just don't know how bad this is going to be. But we can also see the margins going up over time since the acquisitions. The return on invested capital is also going up over time since the acquisition. We can see the baseline return on invested capital is above 10%. The company is buying back its own shares over time. And if the share price is super low, like it is now, it means that the company is going to be able to accelerate those share buybacks, and we're going to see a big impact here. So that's a silver lining maybe for shareholders. The debt's really high, and we'll get back to that as well. But this is one little caveat because otherwise the financials look great. The operating cash flow is going up over time faster than the capital expenditures, and that means that the free cash flow and the free cash flow per share, given the share buybacks, is going up really nicely. Now, even if this is not sustainable and it drops from $8 per share in 2024 down to, let's say, 6 or 7 per share in the next few years before going back up, this is really not that bad of a financial situation. But like I said, this is just the first glance at the financials. We need to look into the business to see if it's a solid one, if it's one that we want to own in our portfolio anyways. Let's do a quick overview of Fiserv's business to see what we're getting when we're buying Fiserv stock. I recently rated Fiserv as a C on the platform. So it's not exactly the cream of the crop in terms of business quality. But as you can see, even with that mid rating, The value rating is still really high, which indicates that Fiserv is a buy at this current level. As of today, the stock price is $66 per share. But back to the business. So, Fiserv is interesting because it's a collection of different businesses. It's mostly grown through acquisitions. And so it's almost this Frankenstein entity that can be split right in the middle between merchant solutions and banking solutions. And it's really a tale of two halves because each of these categories has different strengths and different weaknesses. Let's start with merchant solutions. This is where Fiserv provides these payment processing solutions to merchants so that they can just accept payments and process payments with their bank accounts. Fiserv's main product here is Clover, and that's mostly for small and mid-sized businesses. And it's basically their entire backend. That's how you run financially the business is using Clover. The main strength of this segment of the business is that it's growing very quickly. Businesses all around the world are going more towards electronic payments, digital payments, and so they need to modernize. They can't just be accepting cash anymore. And trust me, there's a lot of these small and medium sized businesses that are not up to standards when it comes to digital payments. And so, this huge wave of all these tiny businesses getting connected to the digital architecture, MasterCard, Visa, and all that, is a huge tailwind for this industry. That's the positive side of merchant solutions. The negative side is that it's very crowded. There's lots of competition. Here, Fiserv is competing with Toast for restaurants. It's competing with JP Morgan, which has a similar solution. And JP Morgan is a very well capitalized business, so it's very hard to outcompete them on price. Fidelity is doing it, Global Payments is doing it. So it's really crowded. Fiserv basically does not have a moat with this section, but it's still benefiting from that trend of businesses moving online, so to say. So that's the first half. The second half is the financial solutions, and this is where Fiserv provides core processing capabilities to banks of all sizes. If a bank is going to move payments from one account to another, it has to use Fiserv's tools. This, unlike merchant solutions, is a super moody business because once a bank is connected to Fiserv, good luck getting rid of it. As a matter of fact, there have been reports that Fiserv is seen as a mediocre partner. A lot of its banking clients want to get rid of it, but they simply cannot. And so, like the CEO said, even when Fiserv is disrespecting its clients and overcharging and all that, underinvesting, the banks are still going to stay with Fiserv up to a certain extent, but they're still staying with Fiserv until now. The flip side and the negative part of this business is that it's pretty stagnant. It's very mature. It's not growing very quickly. Also, it's a business model that's starting to age. Banks are starting to look for alternatives, stable coins, whatnot. There's a lot of investments being made in this space. And eventually, the banking industry will change, it will move on. And so, Fiserv really has a very good position here, but it's unknown how long they will be able to maintain that position. So, how do we apply all of this information? What to do with all this information? Does it mean that Fiserv is a buy today, or should we stay away from it in case it falls even more? The whole point is nobody knows. Everything's going to depend on how badly the CEO changes go, how badly that margin is going to fall, how slow that revenue growth is going to get to, and for how long. Right now, the free cash flow multiple, like I said, is 8, which means that if we assign under regular times a free cash flow multiple of 15 to Fiserv, given that it's a quality rating of C, this means that the market is currently expecting the free cash flow to basically fall in half. If the free cash flow falls in half, this multiple will expand all the way to 15 or 16 automatically. If I play around with the calculator and I input a price of $66 per share, revenue growth rate of 1% over the next 5 years, margin contraction from around 22, 23 to 16%, a good amount of share buybacks, a normal terminal multiple of 15, I get a total shareholder return of 10% per year for the next 5 years. I personally think that these assumptions are really conservative. It's most likely that 5 years from now, the story will have changed. I think the revenue growth rate is more likely to be around 3 to 4%. Let's put 4% just to try it out. Margins of 17%, and boom, we're getting close to 15% per year. So once again, you can play around with this calculator. I can make it say whatever I want. I could play with the numbers and get with a 20% return if I wanted to. That's not the point. The point is to illustrate that it doesn't take much to get a decent return with Fiserv at this level, even when you account for worse than normal results. One thing people have been talking about and worried about, and for a good reason, is the debt. Fiserv, after its acquisition of First Data in 2019, piled on a ton of debt. And when you see a debt chart like that, alarm bells should be ringing in your head. The interest coverage is close to 5, which means that the company can basically pay its interest 5 times with 1 year of cash flow. So that's not too bad. It's not ideal. We would want it to be higher, but it's not getting to a dangerous level so far. And in terms of debt to free cash flow, it's 5.1 as of 2024. This is a bit high, but they've been bringing it down very religiously since 2021. A big part of that was that the cash flow was increasing very quickly. But if the free cash flow starts to decelerate, this might go up the other way. So this is something to look out for. Thing is, when there's this much debt on a business, there is always a bankruptcy risk. You cannot go bankrupt if you do not have any debt. The one thing that gives me some hope for Fiserv is that the debt is at very reasonable interest rates, and it's been divided into tranches all the way into 2049, 2036, 2035. So the company is going to have a long time to repay that debt. So it's not like, they have to repay this over 2 and 3 years. And at that point, the bankruptcy risk would be a lot higher. So, what's my final thoughts on Fiserv? This is not a company that I currently own in the rated A portfolio, but it could be as a momentum play, maybe, because given that it's a quality rating of C, this is not something that I'm going to want to buy and hold for a very long time. As soon as Fiserv would get back to a normal valuation, that's when I would probably sell if I bought. Personally, I'm trying to keep my investment around A and B rated companies that I have a bit more of a cushion in case things go badly because they'll be able to grow their free cash flow over time. There's a lot of uncertainty around Fiserv. Yes, it's really cheap. Yes, you could actually double your money very quickly in this stock over a year or two if you get lucky. But for now, I'm staying away. There are other opportunities for me in this market that I prefer over Fiserv. It's not impossible that I start a position if the stock price does get down to below 60. That would be really, really interesting. But for now, I'm just watching it. So we'll see how it goes. Good luck to you if you have a position in Fiserv. I hope the stock goes up very quickly. Let me know what I'm missing in the comments below. Is there any critical piece of information that makes this an absolute buy right now or a sell? Let me know in the comments below, and I'll see you in the next one.